Zaner Ag Hedge, bringing you our strategy of the week update here for October 28th, 2021. Remember, trading futures involves risk. It is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Pretty interesting day. Markets are moving all around. We've got corn heading in one direction, wheat heading in the same, with beans wanting to go in the opposite. Dollar index happens to be moving around. We see the dollar getting slammed here today. Energy products have had a little bit of a setback, and all seems to be what is a risk-on day here for the general stock market. So I've got a chart up here of the dollar index. It's trading down towards the 93 handle here again, 93.30 around the 55-day moving average. Also got a trend line here against the lows that were coming down into testing, some kind of channel or a little trend here, potentially higher, trend channel higher forming. Broader picture, though, for the dollar index, we could be, turning over from old broken support now as resistance from our old range for the index between that 94 to 95 area. We broke below it there into the end of last year. We tested it as resistance. We fell back down, found some support around 90, bounced back up, found support around 90 again, have now tested resistance around 93 to 94, and now the dollar index seems to be turning over. And if we don't really hold support here at this 55-day moving average along with this downward sloping trend line, 100-day moving average at 92.80 and the 200-day down around 91.90 seem like they're going to get, be in the works for a test. And so that's where I kind of want to move into talking about the first opportunity I see here, which is actually a U.S. dollar shorting opportunity. Today's not just the ags. I think that there's some other ways we can diversify exposure in trading and in our portfolio. Maybe looking at things like natural gas and crude oil as ways of hedging some of our energy or input cost of corn as well. Using things like the euro currency or the 6E here that you have up on the screen. This is the euro dollar FX or currency futures. It's the exchange rate between the U.S. dollar and the euro currency, of which the dollar index represents 60% of its basket in euros. So you can see the pretty big update here for the euro here, trading starting the day around $1.16, ending the day almost at $1.17. So a full penny or 100 pip swing here in the 6E to take us. That was about $1,200 swing, so it was a pretty decent day. The 1725 area, 117.25, that 50% retracement of this prior decline. If we don't see resistance there, we're probably going to be finding our way breaking out of trend lines. And actually, very similar here, right? Chart. If we were to, I don't know. Let's just. What did I want to add here? Comparison. Very similar chart here to some of our row crops, except here instead of the S&P, we're going to compare soybeans right now.
Should be considering all the concerns about input costs and even availability of inputs, and
Well, that's not right. Give me 1 second here, everybody. Edit study. I thought I put in ZS as in the soybeans. Okay.
That's what I'm wondering too. At some point, though,
it's not changing for me.
Well, the availability of input costs is going to be the biggest problem. But if it is available, these guys are going to pay.
There we go. That's what I wanted to see. So if you look at the euro currency proxy for the U.S. dollar compared to soybeans here, pretty interesting chart, isn't it? We've had pretty clear correlation here over the last several months as the dollar has weakened. The soybean market and the price of soybeans has risen as the dollar has weakened or strengthened here, I should say. The soybean price has dropped over the last several trading sessions. In here, more recently here, we had a pretty good correlation going here into the end of October, and then a little bit of a decoupling there for a few days. But as you can see here, we have the U.S. dollar now, popping back up here and breaking out of its 2-week highs. the U.S. dollar, I'm sorry, breaking down here, the euro currency breaking out of its 2-week highs, and you have soybeans, the price of beans here finally, or potentially finding some kind of reversal. Let me see here. Yeah, that's fine. Anyway, the point here that I'm trying to, of course, show you is that over the last several sessions here, it seems like the beans have needed a reason for, from the market to continue higher. We haven't seen the export markets there. Perhaps this rally in the currency is a reason to, or dropping of the dollar, rally in foreign currencies is a reason to support the price of beans continuing higher at this time. So, with that being said, the idea here that I really wanted to kind of go over was that on a pullback here in the euro currency, a pullback towards 116.60 to 116.50, we might see support. That's broken trend lines against the highs as support, as well as a full 50% retracement off of this low to high. Look for that area as support here for the dollar, and that would be like in the dollar index here, looking for resistance on it up into the 93.50 to 93.40 area. Now that things have begun to roll over. All right, so next, let's take a look here at natural gas. Pretty remarkable move we've seen over the last couple weeks.
But again, the market's reflecting that concern. I'm wondering what happens.
Get rid of some of our trend lines here.
Natural gas.
Because the idea that I'm trying to, or we're trying to capture, or we're trying to put a trade on for is, okay, if this inflation trade continues, if natural gas goes to all-time highs or breaks out towards those types of levels, you can see here back in the early 2000s, we were trading, every time we break above $6, it seems like we run up to 10. You go back in natural gas's history, that $6 barrier seems to be very important. Every time we break above $6, which is where my cursor is on the screen, and actually we could just put a price level on this chart at $6, and we can look as far back as this weekly chart goes. Put it right at 6, make it big, and so we can't miss it. As we move to the right here, and as time progresses, you can see every move above $6 has the chance to have a big run, well above $6, up to 15, up to 10 there. And here, over the last couple of years, since 2014, failure to kind of break out, it's not even, you can't see the line there here in 2019, 2020. We're finally back up to this area. So it makes sense to me to, if we're worried that prices of LNG and natural gas may take off here, using the $6 strike is certainly one way of protecting against that by buying an option at that level. Makes sense to me to own that as a kind of a doomsday, oh no, natural gas prices are going to double or triple from what they hear. You get to at least protect yourself with that. And that can be a pseudo nitrogen or pseudo fertilizer hedge here too. However, now that the market has had a bit of a pullback, after testing highs, maybe we'll come back and fill the gap at 540. Who knows? What I was starting to eye here was in our energy products. Let me pull up our natural gas options. I was looking out to the March timeframe because I think we need to go far enough out in the curve to where we have enough time to see this through. March with 118 days left until expiration. I was looking at the $6 calls, pretty expensive. To buy them outright here at $77,000, right? That's a lot of money to shell out of pocket to buy them outright. Excuse me. Turn this into a $1.50 wide spread and selling these 750s for about 90 cents, paying $1, 10 there for, I guess it's 85 cents for that. For that $8 call, you'd sell and bring in. Buying the $6 call here for, excuse me, I'm selling the 750 for, let's call it 88 cents, and we're buying the $6, excuse me, for, let's call it $1.14. For what's that, 24 cents, call it, cost here. You have the opportunity to make potentially $1.50 So you get a decent risk reward ratio there for risking $2,400 to potentially make $15,000 if the market actually takes off and we break out above 6. Right? It's not getting you the big bang all the way up to $10, but for a way of limiting risk in a market where we think where we have the opportunity for a big volatile event above a certain strike price, using a call spread like this is a way of limiting that risk. And certainly through the March timeframe of having 118 days left, should be enough time to see that trade to the end there. And again, right, limited risk on a call spread here versus trying to buy a futures on a breakout, whatever. Knowing our limits there is, I think, important sometimes.
Right.
Limits the upside and what you can potentially make on a trade. Okay, so let's move forward here. Let's move into our row crops. I guess let's touch base on crude because I'm not ready to take a trade here on crude or do something. I like the idea though of starting to watch the value in $85 through $80 calls, see what they go for a month or two out, then start to watch that value decline as the market pulls back if it does like I feel like it should. I would not sell crude oil here. I'd rather be a buyer in the dip. I like the 74 area if we get back down old broken highs, this cluster of highs we had back from through June through September. It's also the 50% retracement from that 61 swing low to the 85 swing high. However, we are holding trendline support here within this larger channel, but I think the channel, we're getting to the point where this daily channel might need to have a test. My issue there is that if we test the daily channel, we could pull back further 60, or why not a full pullback to 45, from that 6 low to the 85 high on the swing chart, or on the that's on our daily continuous chart. But we don't worry about that because there's lots of other things to do. But the 74 figure, 74 to 70, is where I'm watching the market here. And a pullback would be very interested. And at that point, I'd probably start to look at 80 to 85 call spreads, or $80 calls, or maybe even owning futures and buying puts below to try to manage the risk there more exactly. All right, so we've talked about the U.S. dollar, talked about natural gas, talked about crude there. Let's get into the row crops and some of the ideas that I have going forward, because I'm still, after today's price action, I'm still definitely in the camp that I think we're going to go higher. It's very tough, though, with the soybeans. They seem to want to be leading the way lower. It doesn't seem to be as much of a soybean-driven trade right now as it is a wheat and corn-driven trade. Corn wants to go higher, wheat wants to go higher, beans want to go lower. I don't think beans are going to be the winner here, especially if the U.S. dollar is starting to become very bearish as well. So let's take a look here.
Does price matter for our carryover too? I guess is my question. Right?
Look at that daily December corn chart.
I would say that it's trading $1 or $2 too high on soybeans, but China's buying regardless, and then therefore that period will probably shrink, but maybe not down to 180. Well then, okay, maybe 1250 isn't too cheap because that
nice big area of congestion there around the $5 mark that we're all very aware of, that the market's been holding above here, right? The old area of congestion down around 560, 460 doesn't look like we're ever going to see that again. That open gap around 477, just forget about it. We're back up to testing trendline resistance against the highs, and arguably you can make a case maybe we broke above one degree of that we've already kind of come back down and tested there yesterday, and now starting to press and try to break above. Point is between here and 580, that area of resistance is in jeopardy if it is resistance anymore. We're now above the 55-day moving average, which is at 535. The 100-day at 545, the 200-day at 523, and that 18-day moving average has been holding a support now for the last week, 534, and starting to rise. So I'd like to see the 55-day get picked back up above that 100-day moving average, and we'd be back off to the races, I think, for a considerable breakout higher, or at least a test back to $6 in the high end of this range. It seems like what we're wanting to do at this point, and how the market's trading. Having corn up 5 cents and beans down the same amount, it's kind of weird, but c'est la vie. Let's not argue too much with it. and just be happy that we still have corn, pretty good prices on both going into a whole new year. All right, so December corn $4 chart. Here's that trend line. You can make an argument that we broke above it. This yellow one I'm kind of drawing over. We broke above it here in yesterday's price action. We came back down to test it. That was also, if you see here, where I'm drawing from. I took a 50% fib, and I'm putting its bottom anchor at 547 highs from the other day, putting it up to the highs of yesterday. That was the supportive area that we came back down and tested, and then we drove in today's price action up to the 567 highs. Same anchor now to new high. Support is going to be around the 558 area from this kind of little buying algorithm or idea that I'm putting in front of you. Trendline support is going to be coming in around that area, so I expect support to be in the 555 to 550 area at this time. So if you're looking to buy a future, hop in, buy the dips down to that area, in my opinion. The bigger support though down at 537 could easily get tested, and again, that would be a retest of that 55-day moving average and where the 18-day moving average is. So testing down to there absolutely could be a feasible idea at this time, and again, it would be kind of a test back towards our old resistance and our old highs here. Now that we've tested though back into this range that we've been in, back into the middle of that range, we expect momentum to continue to pull us through to test towards how high in this range can we go. And now those areas of resistance that we've cleared through, there's another maybe trend line up around 590, old highs at 594, 611, and of course at 628 and 638. So around anywhere between $6 and $6.40, we're going to probably see that resistance. But until then, we're going to be monitoring this uptrend that we have for December corn, buying the dips, and continuing to look for the market to continue higher. The 570, looking at some options call spreads that I still like. We're looking out into the towards the March time frame now. March corn.
Irregardless of price, if they do want to do this, then they will. Irregardless of price.
There you go. March corn trading at 571 right now. It's basically at the money. We're looking at an at the money January. Okay, so this is the 56 days to go, a 50-cent call spread. It's at the money. 570 calls in Jan corn are going to go for 21.5 cents there. We're turning around and selling the 620 calls, bringing in about 7 cents, going for about 14 cents. So getting a 3.5 to 1 reward to risk ratio on that for basically at the money. With 56 days to go. If we're going to continue higher aggressively, this is a great way of, hey, let's own an at the money call. We're not so certain we're going to bust above that, $6.20 to $6.20 range, right? On corn that we're seeing has a lot of resistance over the next 60 days, but we think we're definitely going above 570 or going to continue higher from right here. We're betting that we're going to be staying in the upper end of this range in that 60 days is what this type of idea says, and you're trying to make 3.5 cents for every 1 cent you risk with finite risk. I think it's got an interesting breakdown of how you want to play a range in the market and have a completely encapsulated trade plan with how you execute in options. There's of course always the idea here there's always the idea here in December corn where we just go long futures. Again, maybe we're a buyer here around 660 or 550, no matter where you buy. I really want to take a second and point out how there are options here that a week or two out, specifically 2 weeks out right now, that we can use. They're off of the December contract. They've got 2 weeks left on them. We're trading at 565, so the at the money put's going for 13 cents. If we were a buyer here in December corn, let's call it around 560 just for the sake of ease. There might be a penny or two discrepancy here. But the idea is that we could buy a 550, a put 10 cents below us for 5 to 8 cents. That's the goal here. For 2 weeks period, we want to spend 5 to 8 cents on putting a risk profile of 10 cents below us using a put here. And that 6 1/4 cent you're spending means that the risk between 563 and the 550 strike is 13 cents. plus that 6 cent cost, plus another cent in commission, what have you, means that for a 20-cent total cost or risk in the market, you could be long December futures from right here. And if we're above 550, you'll remain in that position over the next 2 weeks. With the other side of that would be to be going long December corn at 563, putting a stop 23 cents below us down at 543, which that ends up being that 543 area ends up being could easily trade here over the next week or two, and then bounce higher, so you wouldn't get stopped out in this event. So I like using, again, being long the futures. Go 2 weeks out, next expiration again 2 weeks out here. So let me pull those options up here. You didn't see them. An expiration 2 weeks out here on the weekly options. These are week 2 Novembers. All right, the 550 put is going for 6 1/4 cents. I think that against the long future right here would be a good example of a trade to get into. Now, if we pull back, right, let's say you're a buyer in the futures at 550. Well, then look at the 450 puts. You're going to end up spending a little bit more on them at that point, probably more like the 6 1/4 cost, because the market will adjust for that price action as well. But I like that way of going about getting that positive delta of a long futures position, having finite risk at the end of the day here for corn still. So buy those dips. I'm not so certain we're going to be seeing much below 545 in terms of price here for December corn for some time.
I do think that, from what I'm hearing,
so
might be a little bit more aggressive about
let's take a look at our soybeans and wrap things up here today. January soybeans. January soybeans. 18-day moving average down at 1238 right now. It's the lows and the support we're holding here over the last couple days. Kind of an impressive mark. I would say that this market's trying to hold. Give me 1 second here.
The point is, we ran through the bushes, right? And we can do that again this time. So I think the market's kind of ignoring the potential or possibility of either a South American weather problem causing more demand to come to the United States, or the Chinese adhering to the phase 1 trade deal more closely than they have been. If either one of those or both of those,
there we go.
You still have that potential for a powder keg of a bullish story for soybeans, and it's too early to say that that's not going to happen. So I don't know. I'm starting to think that at some point, while the beans have been trying to pull the rates lower,
okay.
At some point, the beans failing to really go down much right now.
18-day moving average down here at 1240. Let's call it now. We're above that area. We're trying to break above the downward sloping trend line that was drawn through from our August highs through our September and October highs here. Failing to do that here today, obviously not a great look. 200-day moving average up around 1291, 55-day moving average at 1283, and that 100-day moving average up around 1315. So we've looked at the November chart. We were ideally looking at this and thinking it was capitulation. I'm still in that camp, and I still think we're heading up to try to test these trend lines and potentially break out. I think we're building momentum here and building up that energy to break out higher. But we'll see if I'm right in that sentiment. We were waiting for that capitulation, that big move lower. It was a grind. It finally came. Now that it's happened along the time frame and everything else we're looking for, something like that to occur, we got to continue with the plan and assume that this reversal is potentially beginning. So very quickly, let's take a look at November, and then we'll move into the Jan chart on the 4-hour time frame. But just to close out some of the levels we've been working at on November beans and to point them out to you, we're up and testing into that area of resistance at 1250 to 1260 area. It's that downward sloping trend lines against the highs that we've been watching, those yellow ones that created that bank. We're also testing that 1240 low from June, okay, which correlates with that cluster of lows we had between 1260 and 1240 all through August and September. We broke below that supportive area. Now we're testing it as resistance. We need to get back above that area to really feel comfortable with the rally that we're seeing. Full 50% retracement from 1183 to that 1249 high that was holding at 1216. It's up to targets as 1264. We almost got there with 1258 highs today. I do think there'll be follow through to get to that level, and I think a breakthrough towards 1290 to see. So
they have things that they didn't account
more
for.
importantly right now, let's focus on those January beans. 4-hour chart, very similar idea. We had that area of congestion formed by that low from June, also from the lows from September through August. That was support. Now it's resistance on the way back up. We have a whole cluster of ways of drawing trend lines against the highs that we're trying to break through from 1260 through 1290. So I expect this market to either blast through this level when it finally gets the gumption to. I think above 1270, we really start to accelerate, or it's going to be very choppy in a fight to get through all of these levels you can see as resistance I have drawn on the chart. All right, so upward target now we're looking for is 1273. That's the full 50% pullback that was holding from the 1216 low on the Novi that we just looked at. That was a pullback towards 1230 here. That has upside targets at 1273, okay? Now, the price action in the last 24 hours was very interesting. We basically, yesterday's price action right here, you can see was a big, wide outside day. We blasted through the order book, made new, blasted through highs from last week, but then fell back down into yesterday's range, although closed moderately positive. There you can see here around 1250. If you look at this price action for just yesterday, down, blast off for the day session, pullback and consolidation into the late morning before consolidation to the close back to about the average price of the day, like right in the middle of the day, right? You know, average price for the whole day, it's somewhere around 1250. Fast forward to today. Try to get it, but you can of course see that it's the same idea. Bit of a sell-off overnight, consolidation, blast off, 915, 930 high, sold off down towards 1145 low, consolidation back towards that middle price for the day. Didn't quite get back there. Would have liked to have seen it get a little bit higher, but it is what it is. And if you look at the time frame in which this happened, 9:30 was the high, 11:45 was the low today, 9:30 the high, 9:15 the high today, 11:45, 12 o'clock low. So very interesting to see the same type of price action, same type of algorithm, something going on here during that time frame, and a pattern that I don't think should be ignored going forward. It doesn't mean tomorrow that if it doesn't happen, it's the end-all be-all. No. Soybeans, to me, and I've been saying this for a few days, are trading something we're not aware of right now. They're trading like they know something. They're jittery. The outside day yesterday, followed by a big inside day today with 20 and 30 cent ranges respectively on each. That's not like the beans we've seen in the last few weeks. That's different, and we have to acknowledge that. It's also different at a time at the end of a month during harvest when we have weather concerns from delaying harvest further, where we're looking at a falling U.S. dollar, which could be helpful to export markets where we're expecting to see better exports. All of these clues are starting to lay their case and build a case for us. We just haven't seen, been able to see that the smoking gun, so to speak, of actual flash sale exports routinely that we saw this time last year that would, I think, convince soybeans to go higher. So if we had that one missing piece to this puzzle right now, I think beans would be heading $1 or $2 higher without ever looking back. But they might do so just on the back of corn and wheat if the rally in both of those markets continue, which they very much look insatiable at this time. So beans kind of want to go down, corn and wheat want to go higher. They're not going to stay decoupled like that for very long. I want to point out, too, before we kind of wrap things up, the move we're seeing as of late, where beans have been a little heavier, corn has been stronger, that, I think, is just reversing that corn-to-bean ratio that we've seen get so wide here over the last year. We got to a 2.6 to 2.8 in the corn-to-bean ratio there when beans were hovering well above $13 and $14, and corn was just around 5. Now that beans have shaved some of that price off, corn price has risen. We brought that ratio back down to 2.2 to 2.1 here today, and that ends up normalizing things again. That ratio feels more normal around the $2.0 mark. And now that we've normalized things, maybe now we can both have them both trending higher together, or maybe that spread goes back, that ratio goes back to 2.5 and beans take off. Who knows? But something seems suppressed. Something feels like it's building here. We're building to a moment of activity. And I think soybeans, the compression we've seen over the last couple of days might be a reason, might be a warning, or, it's quiet, right? It's like it's too quiet. All right, so last week we looked at 1350, 1250, 1350, and 1260, 1360 call spreads in the soybeans. I still like those. Those are actually all off of this January contract. They go off on Christmas Eve. We're looking at the January options. I still like holding on to those spreads. It's obviously not a place to be looking at or getting into those now because we've moved quite a bit of ways. But the 1270, 1370 call spread for 19 cents, I still think there's some value there. That's basically saying, hey, kind of like we were looking at there for a breakout idea for natural gas, where, hey, if we go above the $6 threshold, we think the market will very much continue on, and we'd like to make a windfall if that occurs. A break above 1270 right now for January beans, I think, would be the same type of idea. I think we'd see an acceleration higher, and you'd want to capture a dollar or $1.50 move. 1270, 1370 ends up being a nicely structured call spread, where for 19 cents you have the opportunity to make 81 cents of profit, or a full dollar take a full dollar potentially out of it, and we'll see if that ends up being the case. There's 56 days left on that Jan option, so we obviously need to see the market head higher right now. But if we do see some consolidation sideways over the next couple days, couple weeks, the pennies, or the few pennies you're bringing in for that 1370 call, you might be able to buy it back, take those out, and do some management on the 1270, either roll it down or let sleeping dogs lie without any cap to your upside potential. Because we all know if soybeans want to take off, it was over the same 56-day period last year where they moved well above the $10 threshold and had a dollar rally into the new year. Other than that, I think looking at weekly options right now is an interesting play still, particularly in a situation where we've seen the market coil up as much as it has, like the soybeans the last 3 days. Going into an option expiration, weekly expiration tomorrow, always entices me to take a look at spending pennies in a market where we can maybe make, not dollars here, but make considerably more pennies for very little risk, with finite risk, by the way, because there's one day, these options that I'm about to show you will go off tomorrow after the close. But if tomorrow is a big mover outside of today's range, which was 1240 and 1260 in January, well, a 1240 put will cost you 2.5 cents, and a 1260 call would have cost you about a penny into the close. So for a whopping 3 cents, you can have potentially, buying into 2 weekly options that say, hey, if we break out tomorrow one way or the other, I only need to go 3 cents above the highs or the lows of the day to make back all my costs to have on that that 20-cent wide spread. Might be throwing 3 cents away, and you might be taking too much risk into the close if you go home long one of those options and forget about it, and you get assigned a futures position that you're not aware of into next week. But that's all manageable through execution, right? None of that is a reason not to take the trade. It's a reason to keep paying attention to the trade once you're in it. So going further out, though, you're going to start to have to pay a little bit of time value. But even 2 weeks out, if we feel we're going to break above that 1270 area for 7.5 cents, we can own a call that goes off in 2 weeks. So we just need to get to 1280 to start really making money on this call. 1278, and you're making money. It is 30 cents out of the money, but we have 2 weeks to see if this market will break out under the same premise. So, hey, if you want to get long for a breakout above that 1260 to 1270 area in soybeans, a breakout of that trend line that we're watching here, that we'd like to see it break. If it does, maybe it'll be very quick and very fast, and we'll be able to catch it with futures. Maybe we don't want to take the risk of futures or risk being stopped out in a sideways or choppy market as it tries to break out. these weekly call options are a great way for finite risk of doing just that. And of course, we looked at that January timeframe call spread, the 1270, 1370 call spread that has gives you more time. Obviously, caps the risk at $1 to the upside. But the truth is on any one of these smaller options, a weekly option, what's the real potential gain here? Are you going to see 60, 70, 80 cents of gains? Maybe. We would love for that to happen, but you'll probably, in the best case scenarios, be only seeing, doubling your money or your investment on them. And we'd be very happy with that type of trading outcome, right? Seeing selling an option for 14 cents that we bought for 7 is I think a good trade. And we've only ever had that 7 cents of owning that option of risk out there to begin with, which is the whole purpose of using these. There's not much time left on them, but the trade scenario that we're talking through is probably going to happen here and now or not at all. So we don't need time. We need direction to be right, and we want to take finite risk. These are great ways of doing so with very little time left on them. So, okay, well, with all that being said, thank you for joining me for my Strategy of the Week update here. I hope you've all enjoyed it as usual. If you have any questions, of course, you can always get in touch with me over here at Zaner at 312-277-0110, where I'd be happy to help you turn some of these ideas into real trading strategies and actionable results in your account. Feel free to sign up in the links below for our daily newsletter if you haven't already, to keep up to date with kind of what's going on and a pulse to the ag markets. You can always find me on Twitter at DanSOT, on Facebook, or shoot me an email at dhussey@zaner.com. Thanks, everybody, for joining me. Have a great week, and until next time, we'll be back with you as price action develops. Take care, everyone.